Welcome everybody to our today's feature presentation, how to trade short-term price action in any market. We will demonstrate to you today the opportunity that you have as a private investor to make money with short-term price action. If you can follow this, you have a much higher probability to come out with profitability than if you're trying to aim for the long run. And we'll prove that to you. Before we go there, let us just go first into a little legal disclaimer so that we make you aware of trading has a risk and that you shouldn't trade with money that you cannot afford to lose. And on the other hand, we are not giving you trading advice. We share a trading system with you that we use and we developed for ourselves. And within that said, here you see me on the left side. My name is Thomas Baumann. I'm the inventor of NeverLossTrading. It's an algorithmic-based trading system which helps you to find those critical price spots right on the chart. And I also published 2 books at Amazon. One's called My Stock Market Income, is focused on how you can make, with small accounts in particular, constant income from the markets by following certain principles. And the second one is how to set up your trading career for those who want to be more serious in trading. And so today we want to go into more details within looking at who's swinging the lever. Why do prices move? Who is on the supply and the demand side, and why do prices move constantly? The answer is easy to be given. Institutional investors dominate more than 85% of all financial markets, and within that, they are the dominant forces. We will learn together tonight who are the different types of institutional investors and how we can follow their price actions. So we have the opportunity when they swing the lever to swing with them. So therefore what we propose tonight is having a following system is a much stronger approach than going within trying to be inventive and being before the institutions do something in the market. There's certain ways of how you can even measure that, and we just introduced a new system called NeverLossTrading swing point concept, where we find those crucial price points and also you can use them and portray them on the market. So as a private investor you have a huge chance. Why in a following system would you have a chance? Because you can go in and out with entire positions all at once. Institutional investors, and here you see a couple of them, they don't have that ability. Why? Because they would change the market too rapidly with their entire supply or demand if they just throw it in at once. So they have to gradually go in. And this is where indicators can capture the institutional money moves, and then we can go along with those. So first, who are the different types of institutional investors? First, prop traders, proprietary traders. They're trading their own money. And you see here a couple of symbols of those companies that are dominant in all the different markets. So they analyze very detailed of what's going on. They have the smart MBAs who scan the markets and try to find the next Google or the next whatever winner per category. Then you have all the fund managers. The fund managers are the pension funds, the mutual funds, the ETFs, the hedge fund managers. They often have a following strategy, and they try to be at par with an index. Mostly the most mutual funds never reach the index. So if you take the opportunity when you just be an investor who says I can't trade that often, then buy the spider and sell a covered call every month, then you might be already 12% ahead of all the fund managers, because they do that too, but just on the background, and it doesn't show up in your account. So then you have lower risk investors, banks, insurances. They're always very careful with what they do because they might need the money back from the market and they want to have an interest out of that. And then we have liquidity providers, very strong market force. Those are the market makers, the ECNs, the wholesalers. They provide offering on the bid and ask price and make the entire market happening. There's different liquidity providers. For example, in the New York Stock Exchange, you have 7 assigned liquidity providers. In the NASDAQ, you have more than 300 being assigned or acting as the liquidity providers who help us so that order get immediately executed. So then you see one thing, who are the driving forces in this? Driving forces are always prop traders, be it the stock market, the currency market, the treasury market, the commodities market. So they make the initial price move, and within that we'll need indicators who pick that up by either seeing, okay, big price move happened, or statistical volatility is changing, yeah, so there's like an eruption coming, something is going to be on the move, and that paired with a momentum price change, so the directional price change, gives us a good indication that something is going on. And so this we will show you tonight how you can portray that on a chart. Yeah, going ahead, so the crowd follows the leaders, and you have the unique opportunity as a private investor to go in and out with entire positions all at once. Yeah, so because you know the amount of investments we do, regardless how big our account is, it's not going to change the market. But if one of the institutional investors has 10 million shares of Apple, that is more about what a day's exchange is in this one, and so therefore they would change the market, and we don't have that many to sell or to buy, and so within that we can go in and out at once, get filled, and leave our positions, go to the next, and compound interest. A wonderful way of trading. Yeah. So how do we find those short-term price actions? Yeah. Technical analysis is the key tool for everybody to do this, and you basically have three choices. You use a moving average based system. Moving averages are very simple to be calculated. Here on the chart we have, for example, the 9-day and the 18-day. When they cross, then there are certain implications where people go long and short with. Or you have a prediction-based system. Here I put the Elliott wave. Many years back I tried to operate with it. So you have the 1, 2, 3, 4, 5 wave, and then following the ABC wave, and with that you get the predictability of how the next price move shall be. Or you have cup and handle, head and shoulders. All those conclusive patterns are prediction-based systems. And you have activity-based systems. That's what I want to introduce you to. There's not many available for the private investor because they are measuring institutional action, price expansion, leaving of certain price levels, going to the next. And there's a lot of math behind it, or quant theory, and you have the ability tonight to sign up for one, because always our spots are limited because we teach individually. Yeah? And so the consequences out of those systems are different probabilities for success, and we tested them. These are our test results over many years, I'd say 10 years of running very many statistics, because I myself started out also with moving average based and candlesticks and all of that, and I programmed them in algorithms, but the likelihood for having the right trade setup and bringing it to the end here in the moving average based system is between 53 and 55%. And so I took a mean value of 54% that I found in here. So that includes also Bollinger Bands, MACD, RSI, stochastic. Yeah, so then you have the predictive systems. Yeah, so one happening comes, the next happening is going to be predicted. They're really actually on our statistics about a 55% probability for success. And then when you go with algorithmic trading, you are able to move into a direction of higher probability, above 66%. Yeah, or above 65%, we take 66 and 67 for our calculation. But what's the consequence out of that? Let us work first how you can determine what your trading system is giving you, or anybody's trading system that you evaluate, and we're always open. If you want to see how it works, you call the shots. The individual symbols we show you, which count good trade, bad trade, and then you'll see if it's high performance and high probability or not. Yeah. So back test about 100 trades, forward test 10, take your average winners, losers, and then you know your probability. That will be very, very essential, because what I show you here is the golden rule of trading. If you can stick to that, your trading will be better, because you have to wait for opportunities where the probability for success of the setup, yeah, which you get from past performance, times the reward that you're trading for, divided by the risk, and the probability of failing is bigger than 1.5. Only then, when you trade like this, you will be long-term in the game to make money, else you most likely trade water, or you will be making a loss. Yeah, so here's an example. If you trade 1-for-1 with a 65% probability, that factor is 1.85, and thus it's about 1.5, so you have a good trade setup that you found. If you do that with a 58% probability system, trading 1-for-1, the factor is 1.38, and it's below 1.5, and most likely you will not be making money. Yeah, it's a very simple calculation, but you say, okay, I might find opportunity setups that are 2-to-1 or 3-to-1. Yeah, but that has consequences. When you aim for a longer price move, you're longer in the trade. So we put that all together and say, okay, what's the average time of the trade if you go above 1-to-1 setup? and we found out it's about 10 to 50 bars to realize your profitability, while when you trade for one-to-one, yeah, you have about 1 to 5 bars in average. And there we took a mean value and say, okay, the mean value being in a trade is here 20 bars, depending on the time frame you trade, or here 4. Now let's calculate the returns of that. What we control in trading is the risk. So if you want to risk $1,000 to make $1,000, and we do that and stay 4 bars in a trade with a 67% likelihood, that means we win 2 out of 3 trades. On 250 opportunities that we participate, that means we can make 60 money turns, or we can produce a profit of $20,400 out of $1,000 risk with a win rate of 2 to 1. Yeah, 2 we win, 1 we lose. And so when you do the same and you aim for a 2 to 1 setup or 3 to 1 setup, yeah, so you risk $1,000 to make 3,000, or you risk 1,000 to make 2,000, but you're longer in the trade, the consequences are your return expectations are drastically lower, See here, a high probability trading system within being short-term in a trade produces 5 to 8 times higher returns than the ones where you try to aim for a very long run, and within that you stay longer in the trade. So therefore today's topic, how you can make money in all markets with short-term actions. So change your thinking, participate frequently, don't shoot for the moon, shoot for short-term price returns with meaningful risk-reward setups that gives you much higher return expectations than anything else out there in the market. Yeah, so how does it work with activity-based trading systems? So a little bit of the insights. So activity-based trading systems always should give you clearly spelled out entries, exits, stop, reward calculation, risk calculation, and probability, so that you know if your factors are all given, and you only trade when the odds are in your favor, and you calculate those. I'll show you later an example of how that can be done. So how do the systems internally work, and what's the natural model behind it? The prop traders, as you saw them, those are usually the instigators. They make a price move happen, move the price out of a certain range, or indicate in their internals of the price move that something's going on. Then everybody's going to mark the highs or the lows of the consequences of their action. When the market buys in, that's what we do too, then we follow with the market, and we calculate how far it can move with a calculation model, which we call SPOO. I show you this one, and within that we always have our entry, our exit, our risk, our reward, puzzle it together and trade when it's in our favor. Yeah, and so that's how it's portrayed on a chart. You see here you have an opportunity where certain signals tell us go for the trade here to the downside, trade to the upside, and you see how that dot on the chart marks the exit point. And then when you calculate your risk-reward times the probability of success, the model will tell you, and we give our students computer models, is it a good trade or bad trade? Do you want to take it or not? And what's your position size? Yeah, because you know, as higher your probability and your reward and your factor, as more you want to put in, and as more risky, as less you want to trade. Don't always trade the same size position. So you see here on that chart, high probability trading, we were able to capture 7 wins, had 1 loss, and the last trade over here was open. Yeah, so we put that all together in trading systems where we help individuals to learn how to use those high probability setups on multi-time frames, as a day trader, as a swing trader, as a long-term investor. So with the first 3 systems, we followed prop trader action within looking at price internals. Top line is the top of the line. It gives you strong price moves on the chart. Institutional engagement is proven. When it gets confirmed, we trade, and we look a lot also on comparison data, correlation data, seasonality. You have your own scanners for the market that is taught in 20 hours of teaching, because you know that we'll need to change a lot of the mindset of the people, and so therefore we teach individually, tailor all our systems to your wants and needs on your time frames available and on your preferences of risk. Yeah, so then we have for the high frequency trader, so often the day trader or person who can really go in the markets very often, we have a specific system, high productivity, by giving a lot of more signals than all other systems as well. Yeah, or our newest edition for following liquidity provider moves that has really very favorable setups on the reward to risk. And you have to wait a little till the opportunity comes up, but that comes more frequent than you might think. So therefore, we have different system catering to your needs. I'll come to that at the end, and now I want to portray them a little on charts. But before we go there, here's the SPOO calculation. That's important. In any case, somehow you need to determine where the price will be accumulating. Yeah, so it either happens on a price of the past if you have a mark there, or it happens after a certain price expansions where the institutional investors might be good and taking profits, and within that then sell orders or buy orders depending on the direction we traded can be happening, and we are able with that SPOO calculation to put that in action. Yeah. So now a couple of examples of how that looks on the chart. First, top line chart. So you see here we come out of a zone of ambiguity which we color purple, because when we go down or the market goes down, it's colored in red. When it goes up in blue, so you always know the sentiment. So you saw here we came out, 2 signals triggered, said, okay, that's a trade setup. We consider it risky, so we would only trade very little. But it came home, and as we said, it usually 4 bars. So this was the bar of entry because the price threshold or low was surpassed. So we would enter here into a trade. And here on that candle, on this candle, we exit. So 1, 2, 3 candles or 4 candles later, the exit is taken, so the red dot marked the target. So then we turn around very shortly after. We come into the play again on a reversal signal, that orange signal, and the target is up there. So favorable risk-reward setup, and it came right home. It was a favorable trade, so we would have risked more and brought this one home. And then the next opportunity comes up when the price breaks out of that price range, which is boxed in that gray box, breaks out of here, gives us an indication to go long, and comes wonderful with a higher reward than risk to target. So let us see how that looks at a different model. This is here our income generator model. So also here we had a sell signal coming out, giving us a target. Risk reward on this one is doubtful because it's too high, so we wouldn't trade it. Yeah. But then here you have a wonderful setup. The computer generated target is here. Risk reward would be okay. But we also can take our historic price accumulation point and trades towards it. And then you see, alrighty, that got there, but also we had to increase in our time in the trade. The first target was reached very quickly after 2 bars, but had we aimed for a longer target, then we need to be staying longer in the trade till we realize it. And so that's the consequences of different styles of trading. It's often nicer if you have the right setup, take a short-term hit, go in, turn your money around, compound interest, you will be way ahead of anybody else who's trying to aim for the long run. And that's what you see here on the chart as well. That's an example of HF day trading. What we are looking at is a 1-hour chart of the QQQ. Let's go left to right. So first signal, sell signal, the price threshold was the low of that candle is surpassed. There was the goal. 1, 2, 3, 4 candles later, out. So here you get another signal. You can add to it because now you know it's a high probability trade. So you add to it and you might do a little longer run, and then you take you out here. So we're coming to bottom reversal signals. Those pink ones tell us, oh, there's pressure bottom up. Entry in here in that candle, sweating a little in this one, but you know always with our systems where the stop is, the stop's at the red line. So when you go down, here's your stop level, that red line. And when you go up, the stop level is going to be here. So we had our stop here, and usually we keep it at the initial stop. And within that, coming into the trade, then after the gap up, we've been really happy, because this is where we went in a fast motion, made double of what we wanted to do, because the price then jumped up and carried us through. How did that happen? It was in a gap up in the morning, but we have these quant lines, which we call lime lines here, guiding us where prices most likely accumulate. And you see here how they accumulated at that dashed price point, and you learn how to use all of that in your trading with our systems. Yeah, so you'll see high-frequency trading gives you multiple opportunities for making a return and gives you multiple opportunities for entry and exit. Yeah, so here's the new swing point concept. It truly has to be explained, but you see here we're coming out of here, we swing to the low, that's the expanded target. You see here we had a historic line, so wonderful trade coming to the downside, and here getting approved again, but we're already on the run on this one. Then we find a swing point on the bottom that we would trade also against historic price lines. So you have a wonderful risk reward setup and a quick motion. So it's either filled in that candle or at least in this one. So a couple of candles later, you got your target hit or you got your target hit in here. And you're ready for the next. So here after that big fat candle, another swing point, swing to the upside, swing to the upside, and there you see your targets being put on the chart. So see how often you can turn your money within making and following these institutional money moves. So that's the swing point trading concept just this week introduced to the market and ready for going through within our teaching. So next chart shows high frequency trading again. So we have bonds, 30-year bonds, and this time we got them on a 4-hour chart. And you see the same check marks give you directional trades that worked out. So we're coming from left to right. This one came out here. So 1, 2, 3, 4 bars later, it was home. Yeah. So then we had end of purple zone signal. Yeah, came home too. This signal was not acknowledged, not acknowledged. Yeah, so then you have the pink signal getting acknowledged, and that's usually a longer run. So you run it all the way up here. And then you see here on that chart also with the bonds on a meaningful time frame like a 4-hour chart, we had 7 positive trades and 1 failure. And as said, so if you're interested and you like what you see here, we're happy to demonstrate and show you the shots on whatever symbol you call. Yeah? And here's our base system, which we call TradeColors. There you follow a sequence of 2 blues, 2 reds. If the high is taken out, then you take it. So you saw here, there's multiple opportunities to go long and short on that chart. Very basic system within just following those colors. Here you follow what the followers do, that the fund managers go in. So you go in with them for a very short period, and it's calculated up there how far it will most likely expand. And you learn further details in your training, which we do very individually and also individually on the times that you are available, so that you don't have to watch a video and sit with 20 people in the class. So you get your individual training catered to you and focused on your wants and needs. Yeah, so the second thing to trading, besides having a high probability system, is having a fish finder, knowing what moves and what time of a day can I do what best. So we put that all in timetables. That's also on our web page, where you say, okay, between 2:30 a.m. and 9 a.m. we mostly trade futures because there's not much available, or forex. And here we have our day trading alerts, yeah, because we got a full alert system of different reports that go out every night to our traders, and giving them the opportunity to find which of the instruments have market pressure. So then you see between 8:30 and 9 we have the pre-market movers. Those we trade on a 10-minute chart, for example. And so we keep your day scheduled, and it doesn't mean that you have to participate in all the opportunities, but you can pick and choose what's available to you and what suits you best. And within that, then you can focus your mentorship on things that you're interested in. If you want to be an option trader, you'll learn it. If you don't want to be an option trader and you don't consider that, you rather trade stocks and futures, or stocks and forex, or forex, whatever you desire, we'll tune that always with you, and then we focus on those asset classes. And you see it goes on that you have a clear timetable, what you do when, and what supporting instruments you use for finding your trades and for executing them. Yes, we here also our day trading at 3:30, we close out positions, and so with that you find here a very nice timetable which is guiding you and which is helping you to make the right decisions for your trading. Yeah. Next point, risk handling. The most we control in our trading is risk. Yeah, depending on the level of risk we have to accept in relation to the reward, we define our position sizing, but in no case we want to risk more than 5% of our trading account in one single trade. Why is that? Because, you know, if you do more and you get a hit, because even a high probability trading system can get a hit at one point in time, you don't want to have a high drawdown. You always want to be able to make up for an individual trade, and so with that we'll work with you what are minimum expectations. Like for example, for options, you will learn if you trade options, your minimum expectation will be 30% returns. Wow, man, that's high, but on an option, if you get the direction wrong, you quickly lose 50%. And so when you make 2 times 30% and 1 time you take a hit, so you win 2 out of 3 trades, then you're still positive. If you violate this rule and you trade for 10% twice, and on the third trade you get a hit, you're with 20% of your investment in a ditch. We don't want that to happen. So risky setups, if you even trade only half or less of the positions, and then with favorable setups, yeah, those are your home run setups. There you give it all. You give that more, and within that you have to have yourself to be a good risk manager, and a good risk manager has tools. Yeah. So what we put together for NLT students is odds ratio and positioning tools. So you put the individual situation in here with just a couple of entries, the rest is all calculated for you, and then it spits out and says, look, looks like a two-lot trade, but you decide. Yeah, it's always your decision. The computer does that. So if you have a $50,000 account for that, and you want to carry 10 positions, then it says, look here, your investment amount here might be $10,000, and so for that you're aiming for a 3.3% return, or you have a 2.6% risk. So all is in nice guidance, yeah, within what we want to do. On the other hand, we evaluated the situation for trading the options of the BBD, but the setup was not so favorable, so it says, yeah, it's risky. Look, the odds ratio is not given, so therefore only maximum half a lot, and it calculates through with half a lot of what you can expect on the risk side and on the reward side, and within that giving you indication of what you can do. But the final decision always is with you. You are the pilot of your destiny, but we give you all the instruments on hand and the teaching that you can make a safe landing. Yeah. So productivity is a key goal. Our systems are set up of multiple of those indicators. Let me give you an example. So for example, the HF trading would include this productivity, this, and this one here. So you add them up, but on single indicators, the new indicator that came up and that we're introducing now is very highly productive. Yeah, it has a strong productivity. Right after the top line indicator, it indexes very high. Why? It has a high probability setup, and it has a very favorable risk reward. So it's a nice thing for an entry level algorithmic trader to enter into this, or you'll go really serious. You take one of those systems where you have high productivity by adding up individual components, and within that come to market to participate with a high participation rate. High participation rate means more earns and turns, and it means also less risk at a lot of the positions, and with that you're usually up for making more money. How does it all come together? So you have the chance to trying to find all these action points on your own with a different system, or you go with the proven systems like NeverLossTrading. We are teaching people, and we are in business since 2008. And you might not find one complaint on the internet. What's that telling you? And a lot of our business is referral. Yeah, people say, okay, that helped me out, it got me to where I wanted to be, and so therefore we have a lot of referrals where people come to us. So we are not the strongest on internet marketing because we also have limited capacities. Yeah. So then, what does a mentorship include? What's all in it for you? If you take a mentorship like Topline or HF, your software gets installed on the server. Yeah, it's a real-time data platform. It's all plugged in into Thinkorswim, so within that you have no monthly fees. Yeah, so many like eSignal or so, you pay $150 a month for data draw. So here you pay nothing. That's a big advantage. So we had some people coming in with TradeColors.com because they said, "Wow, that's a one-year payback towards my payment of data draw," and so that within that they changed systems. Yeah, position sizing will help you on this one. We help you with times in the trade, risk approximation, and give you a total way of trading the assets that you want to trade, or introduce you to new ones. Introduced very many people to trading futures because they're great instruments to hedging, or trading options, right? Because there's a lot of things or mystique around options that we demystify, giving you a clear thing on hand of what you can do. And also we do a business planning with you where you know how productive can you be, how often do you want to trade, what earns turns ratios do you want to come up with, and then work you towards it. Yeah. And so that all together comes then with the training of the system installed, the training on different asset classes. You get also 3 months of NLT alerts. So those are alerts for day traders, swing traders, telling you where the money moves. And that all comes together in our offering for helping you to be a frequent trader. Think again what I showed you prior. If you have a high probability trading system, you can trade for one-on-one setups. You do that frequently, you have a much higher return expectation than with any other system. So give you this ability to produce on earns and turns and move forward with your trading, either within developing it on your own, and it only took us 20,000 hours to do so, or you'll come on board with a market-proven concept and we'll teach you and we help you on board. Yeah, so again, those are our systems in overview, professionals that take that, and many NeverLossTrading students that trade with more than one system. Because you know, why do they do that? They paid back the first one, they go in with the next, and they add to it because it's participation rate. If you do short-term trading, everything is participation rate, or we also allow, if you start out with an entry-level system, like here, and you want to upgrade later, we take a discount from your tuition already paid on the payment that you have to make to upgrade, and we help you on board coming into the slot of the high probability trading. That's our newest edition here, selling for $4,997. It comes with 5 hours of training. Here you have 20 hours of training, so you see also there's a difference in time we spent together, and also there is a difference of programming time, because this here comes with more indicators. This one has about 15 indicators, and this one comes with 5 indicators that are portraying on the chart of what most probably is going to happen. Yeah, always high probability trading system. Past performance cannot be taken indicative of future results, but we want to work with you on those charts, helping you to find spots where you can enter and exit favorably in the direction of where the big money is driving the move, or you indicate or notify when, for example, a liquidity provider adjusts the trade position within bettering the inventory position you don't want to be in. So you also learn what not to trade when one of the institutions makes a move to trying to lure you in, going long or short, so we help you to not being on the wrong side of the trade. How can you reach us? You can schedule a private consultation. Yeah, we'll give you an hour of going through different things with you as 1-866-455-4520, or write to contact@NeverLossTrading.com. Again, my name was Thomas Barman. Yeah, I'm the principal of that company and founder, and most likely going to be the one that's going to train you. Yeah, so because we have individual time together then to develop you in the trader you want to be. Our spots are always limited, so therefore act on it, because within the individual training there's only so many hours in a day that we can spend together. But we're always flexible. Customer service is our key goal. So whenever you have time, we will be with you and we'll work you to be the trader whom you want to be. Thank you very much for your attention. Appreciate you being here. Hopefully we hear from you. Good trading. Bye-bye.